All right, let's move on to this MSCI article. It's another one where I think that you're gonna be a lot more informed than me, because at Great Capital we're not lenders, we're investors. We use lenders a little bit, so I wanted to shed a little bit of light on the lending side here and maybe learn something in the process. Now, I have here on the screen. I'm just going to kind of cut to the chase here. This is about collateral losses. So basically the relevant quote on this article here, and this is the title of this is "The What and When Matter for the Losses of Real Estate Lenders." And the quote is, "Lenders who originated loans late in the cycle, such as debt funds, tended to have larger unrealized losses on the underlying collateral. The lender group that stands out is the investor-driven group, a category that includes debt funds and other financial lenders. Banks in general also originated more loan volume later, which is 2021 onward. The pain, as I'm reading it here, is in the form of these decreasing values for assets bought at the peak of, CRE price fervor right before it went, all the values for everything went down. The buildings that these people got loans for, I think, I could be corrected here, these buildings got to be worth less money. And so that means that the banks are a little underwater or have these unrealized losses. Like, they're not losses if they can wait long enough for prices to go up. And that's my question. That leads me to the end of my notes here is, how much is price growth? How much price growth is needed? So we're looking at a graph right here that shows a bunch of unrealized losses for loans that were started in 2022 and 2023. So how long until all these losses break even or get back? And is this a crisis?
No. So what I would say on that is, yes, it has. I like how they kind of framed it here as like what and when matter, and I think. The reality is everyone's collateral went down. It doesn't matter if it's like a bank. It doesn't matter if it's a debt fund. It doesn't matter if the agencies, whatever. Everyone's went down of the underlying amount because we know that pricing. Now, anything that traded, not everyone's value, but anything that traded, it went down in price. But it really matters. This is where kind of the risk mitigation on the lenders matters a lot. And how was it levered? And the reason they probably called out debt funds and banks here is they oftentimes collateralize shorter term investments. Like typically when we go and we were getting size, like if you wanted to do a value add, it was a lot harder to go get agency because you were locked in for 10 years. So you were bringing a ton of money to do the rehab, and then you were only getting 65, 70% loan value. So you were bringing a lot of money. So it was hard to kind of push your returns. So you got a loan that was a little bit higher and a little bit more aggressive, and you use that money from the loan to do it, but that means that you were probably getting some 80, and I've heard stories on debt funds of like pushing 90% of your cost at your loan. Well, then all of a sudden,
really 90%
on some debt funds because they were giving you money for the rehab, and so they gave you a principal loan of, call it 75% of your loan, but then they funded your rehab because they thought that the value of your property after you did the rehab would stabilize, and it then would level out to be approximately 70% of the after renovated market value.
Okay.
And so they sized the loans to that after renovation sizing.
Okay.
Agencies couldn't do that.
Yeah.
Agencies had to be very, very strict of like, this is our 60, 65.
Our debt funds have higher interest rates though, usually?
Yes. They're floating because with debt funds, with like a bank loan, a lot of times what it is it's like a 2-year bank loan with like 2 1-year extensions. And so when it's short term like that, they have to go based off of SOFR, or at the time, starting in 2020, it was LIBOR, then they transitioned to SOFR.
I remember that.
And so you were kind of locked in with that. And so a lot of times your banks were 2-year bank notes with 2 1-year extensions.
Okay.
A lot of your debt funds were 3 years with 2 1-year extensions. So they kind of looked like 5-year, but you kind of had this retesting every year of, are you hitting your debt service coverage ratios? Are you kind of hitting all of these metrics? Okay. That could basically kind of put you in technical default.
Yeah.
Agencies, it's once you're locked in for 10 years, your interest rate's not moving. And so interest rates going up didn't matter for those people being underwater because their payments aren't going to go up.
Okay.
And so that's kind of where it happens here with a lot of these is, if you're at 90% of value, if you're levered at 90% of purchase price, and and the asset goes down 10%. The debt fund could take it and still break even.
Mm-hmm.
They're not going to make a ton of money, but they could break even.
Okay.
What happens is when you are levered more than what that reduction is, so like, let's say 20%, the value lost 20% of the value. Well, if you levered at anywhere between 80 and 90% and it lost 20% of its value, you're underwater.
Okay.
And so that's where the struggle comes. Well, then what happens is as short-term interest rates went up, if a lot of people had caps on these properties, but even though they had caps on it, they had to fund these cap replacement reserves. So money that would have been going to make the property more valuable now is getting taken out of that and being put in these reserves. So now the property market is telling it's going down 20%. They're not doing the rehab, so that post-stabilization value is not there. And people aren't able to make their interest payments because they're running out of money.
Makes you think that, it makes me wonder why there wasn't a spiral in crisis for some of these.
And that's what when you talked about the loans, like that's what happened. And that's why there was that concern. But what's happened is people didn't want to take these markdowns. And so they've given a lot of extensions.
Oh, okay. Yeah, that's what the Federal Reserve was issuing that guidance, I think, last year was like, give them a break. And if they ask for another break, give them another break.
and so that's kind of what you're seeing is if they giving them extension, they don't have to take the markdowns on that. They can take these as unrealized losses as long as they're continuing to make their payments.
Okay.
If they're able to continue to make their payments, they're probably not going to foreclose. They'll probably continue to extend.
Yeah.
But if they stop making payments, that's when they can kind of force the issue. And that's where it's, okay, how much has the property lost value? Now, again, with your banks and with with your agencies and like HUD financing, like a 223F or like a Fannie or a Freddie, it's locked in for at least 5 years, probably 7 to 10 years, because if you bought, rates were at a point where it made sense to do that.
Yeah.
So you're locked in. They're not really looking at that change in value. It doesn't matter because you have time to weather it.
Okay.
But those short-term bank loans and debt funds, those are the ones that really struggled because they were levered so much more than the risk assessment that should have allowed.
Wow. Okay. So that's I just wonder, like, because this chart here, it shows that we're looking at like 20% losses for these collateral, and I'll bring it up again. Looking at 20% losses for the collateral, and apartments were bigger than office, and we know how, we know what office is like, and I guess, are we going to see it? So what we're counting on then is 20% of price gains over the next several years in the apartment market to erase those.
It's not even 20%; it's 25%. Because if you lose 20% of your value, you've lost 20%. So in order to get 20% more, what percent of 20 is 80?
Oh yeah, okay, wow.
So you actually have to increase your value 25% just to get back to par after losing 20%.
What this makes me think is that things aren't over. And, we had a whole, last year we had a whole, a series of reports on distress and on the financing woes of the apartment market, and how maybe this massive increase would maybe create distress, especially with loan maturities for some of those short-term loans coming due in October of 2023. That time passed, and we didn't see it.
And I think this shows you why they did.
Yeah.
Because they lost value, and so there was no money.
It's better for both parties if they just ignore that deadline and just wait.
As payments are being.
Yeah. Okay. Well, I guess. Okay. So they're in it together. It's a bad thing if the bank goes. It's bad for the bank and bad for the lender. But
because they don't want to own. They don't want to own properties.
Yeah.
They are in the lending business, just like you said at the beginning of this. We're in the ownership business. We're out in the lending business. They think the same thing. We lend money. We do not want to. We do not want to own these.
I wonder if it's ever going to get to a point where, all right, it's just enough so that it hurts the borrower and not the lender, and that's going to be the time when the banks are like, all right, give me all my money back.
I think we see it a little bit, and I've seen a couple of deals come out where it really happens is though they kind of gave a lot of places kind of gave a courtesy 1 year extension on some stuff. We're kind of getting to that point where, like, I think October was where we saw last year. We've seen it a little bit. A lot of those extensions with the rate drops earlier this year, some people were able to refinance.
Yeah.
Some people haven't been able to, and they're having to bring money into the deals to kind of right size them. Okay. To where now, because of those unrealized losses, the the people have to bring money in for the lender to keep it on their books. So that way it's less hurt for them.
Okay.
And so you're kind of seeing it where a lot of people for 1 year kind of got a complimentary courtesy, hey, we'll give you 1 year. But now you're getting to the point where you're going to start seeing some deals coming out because they're just not going to do that anymore. They want the money back. And if you're going to keep it, you're going to have to come to the table with some money in order to keep it.
Okay.